bro, you really can't make this up. The Russell 2000 had 2 good days in a row. It's still down 5% from all-time highs, and there is seriously investors going on CNBC today, and I'm shocked by this, suggesting that this market is in a bubble, saying that you're seeing more risk appetite today than 2021. Keep in mind, if you were not investing during 2021, you may not understand this. But if you were, or if you weren't, 2021 was really a year where the worst companies were doing the best. Like companies everyone knew were dog shit, like terrible companies were skyrocketing because rates were low, XYZ other reason, okay? Well, this is not anything close to 2021. Why do I bring this up? Well, glad you asked. Because if Wall Street is so nervous about this market right now, that means there is a lot of upside. A lot of upside. Because that means the fear is even larger than what you can accurately represent in the indexes or on fear gauges. And that to me gets me excited, because the last thing you want is everyone bullish. Everyone bullish could be kind of like a bubble, right? You could be walking into bubble territory. You're far from that. The funniest thing is, I've said on this channel for probably 3 to 6 months now, just guesstimating, that I think we could have a euphoric market that almost resembles 2021, but not in a bubble like we had then. More of like if you're a good company, you're going to get exponentially rewarded. If you're a bad company, you're not going to get rewarded. And bad companies are not getting rewarded in this market. That's how you know this is not a bubble. And that is why we already know stocks are going a lot higher from here. Now, I'm not a financial advisor. I'm not a financial planner. Obviously, anything can happen in the interim between now and then. You know, seasonality in September is a little dicey. We'll talk about it in this video. But I'm really confident that the last 2.5 months of this year is going to be very strong, and 2026 is going to be exponentially strong. Not for all stocks, not like 2021 again, but for the companies that are actually executing, growing, and surpassing expectations. Meeting expectations is not good enough. You have to be excelling upon those expectations. And while I think Mag 7, some of the hot stocks now can do okay, I think the far bigger opportunity right now lies in the stocks that are small caps, that benefit from interest rates, that are pure play AI stocks that people don't know about yet. There's a bit of a valuation arbitrage going on right now between, let's say, something like a CoreWeave or SoundHound or BBAI, Palantir, okay? These are widely known stocks. Well, you could take a company that's $1 billion market cap that nobody really knows about. If you said the name, people would not really have any idea what you're talking about, that are growing at faster speeds, that have, you know, less saturated ownership from institutions, okay? Heavy insider ownership with a decade or more of hyper growth ahead, that are trading at a fraction of the price of these well-known stocks. That is what we are doing in the trading community, going out, finding those opportunities in small caps. To really get these 10, 20, 30x returns, you have to normally take on a lot of risk. Normally, it's like do or die for a company like that. Normally, if you're going to get a 10, 20, 30x in, let's say, 12 to 36 months, 1 to 3 years, the stock basically has to be like counted out by Wall Street people have to be like very bearish on a company. It has to be at a very low price and then far exceed expectations, like Carvana in 2022. Most people thought Carvana was going bankrupt. At one point, it was a $6, $7 stock. Today, it's $200, $300 because everyone was bearish on Carvana and they proved everyone wrong. Okay. But if you can find the stocks that nobody knows about, you don't even have to have people bearish on the company, right? The value can be in plain sight and just not known about yet. So come join that link down below in the description of this video if you would like to. With that said, we do have a couple of headlines from Fed Goolsby I want to share with you in this video. A couple clips from CNBC, one of which from Tom Lee. He's obviously bullish and he's going to give his bullish take on our markets. But I also think it is partially my obligation as an uber bull, specifically around AI and this market generally over the next couple of years. Really, I'm super bullish over the next like decade because of AI. It is my obligation to bring you the bear arguments. If there is something I am missing, not seeing, I want you guys to be prepared mentally to know what the bear case is, what the bull case is, and to be able to come to your own conclusions. And when people start to talk about bubbles, that gets me very excited because the fact of the matter is this market is far away from a bubble. Like if I were to like put it, 1 to 10, like 1 is no bubble at all. Like no signs of a bubble. And 10 is a bubble. I say we're at like a 2.5. Like we are not even close to at all a bubble. And that is very bullish. We do also have some pretty incredible Tesla news I will share with you in this video as well. Hit that like button, subscribe to the channel, baby. If you have not done so already, check out, again, that link down below in the description of this video to come join the best trading community, hands down, in the entire world. Confident in saying that. Now, before we get into some of the more exciting things that we're going to talk about in this video, let's get the boringer stuff out the way. Boringer, I don't even think that's a real word, but we used it anyways. Fed Goolsby says, need multiple months of favorable inflation readings to get the comfort needed to cut rates. Some Fed officials are like a baby, right? You just got to comfort them a little bit. And, fact of the matter is there's so many Fed officials that are now team rate cuts anyways. It doesn't matter. Like we're going to get cuts. You can see this in the Fed rate monitor tool. Even after Fed Goolsby spoke today, the odds are sitting at 95.4%. Let me refresh this to see if they moved a little bit. 96.6% chance of a cut September 17th because we just have so many Fed officials that are now team rate cut. October 29th, 67.4% chance of a cut. You're now pricing in fact, a 2.3% chance of 75 basis points worth of cuts? Like maybe a 50 basis Jeez, that's incredible. You're pricing in a 3.4% chance of a 50 basis point cut in September, a 2.3% chance of 3 cuts by October, and for December, you're pricing in a 1.8% chance of 4 cuts and a 53% chance of 3 cuts. So you're going to be getting a lot of cuts unless we get some shockingly strong economic data or some really bad inflation numbers. You're solidifying multiple cuts this year. And that's what happened to the Russell. If you did not watch the video that I posted on the channel at 4 p.m. today, I highly recommend that you do because it's actually very simple. This market is not in a bubble. It's nowhere close to a bubble. What was happening is the algorithms were shorting small caps going long Mag 7, okay, going long other areas of this market. And it made sense if you're a bearish hedge fund or institution, right? Because it was kind of a lose-lose for small caps, right? If the economy weakens, looks like we're going into recession, that's bad for small caps. If we have a surge in inflation, that is bad for small caps. But in fact, we kind of are getting the Goldilocks scenario for small caps, where we're not getting this tariff inflation. The economy is not like super strong, but it's not recessionary, okay? Wall Street didn't really have that in their bingo cards, okay? So they were shorting small caps with the expectation of it was a very high likelihood we would either get the economy going through a growth scare, a large one, or we would have an inflation problem. You're not seeing that. The reason for this, not to like be political, but it is what it is. 70-80% of fund managers are Democrats, right? So just take that into consideration, and it's easy to see why small caps have exploded higher in the last 2 days. Okay, it's not because this market is in a bubble. It's because everyone was on the wrong side of the inflation data. That's it. It's literally as simple as that. But I would also point out that even with the Russell going up, so much in the last 2 days, up like damn near 5% total in the last 2 days, very aggressive move. It's not everything. Like, the bad companies are not just skyrocketing here. Okay. Another, evidence point that I could tell you that shows we are not even close to in a bubble. And that said, the Russell's still down like almost 5% from all-time highs, 5.2% from all-time highs. Like, you're not even at all-time highs yet. Versus the S&P, the S&P looks like it's way closer to being in a bubble than even, other stocks, considering the S&P's up like 6% from the same level where the Russell previously hit an all-time high, right? Like, the previous all-time high on the SPY is like 6% high. The SPY is 6% higher than that previous all-time high. The Russell's 5.22% lower than its previous all-time high. Like, you could have a couple more good days, and there really shouldn't be any talk of a bubble. With that said, Fed Goolsbee says, so far, we have had a couple of months of mild inflation. The latest CPI had a concerning rise in services inflation. Again, this is beating the Fed's narrative, where even Jerome Powell at the last conference said, hey, we're starting to see tariff inflation. Goods inflation went up last month, that is. And in this latest report, there wasn't really any goods inflation. Not anything concerning. It was services, specifically related to housing. So if your argument is we're on the sidelines, we're waiting to see about cutting rates because of tariffs, you can't make that argument when you're not getting tariff-induced inflation, right? Makes sense. And that was, again, not in Wall Street's bingo cards. They were expecting to see tariff inflation in this report, and it simply did not show up. Fed Goolsbee says what underlies the economy would naturally lead to lower rates. And basically what that is capitalism, right? Competition, low inflation. We're naturally prone to low inflation as long as there's no stimulus checks or massive government spending. We're just naturally prone to disinflation or deflation because of competition. Like TVs, for an example. You can now get a 50-inch TV for $300. 20 years ago, that was $3,000. Okay. That's deflation, by example. He says uneasy thinking of tariffs as one and done inflationary shock given levies on semiconductors and new tariff announcements. Ed Goolsbee says it is entirely possible to cut in anticipation if you think inflation is on a path to 2%, then stop or hike if information contradicts. So this is one of those headlines that looks like it boosted the odds of a 50 basis point cut in September and 75 basis points in cuts by October. Now, I want to share some news with you as well. Tesla has received approval to test full self-driving in Norway. They will now have 2 vehicles doing the testing. Europe has killed itself from all of the regulation. People say, why is America, so much, why are all the big companies in America, right? People talk about this versus Europe. Okay. And it's really because Europe just killed themselves with regulation. And same is true up until this day, where even Tesla can't get full self-driving into the country after years. It looks like we're making progress towards that, and hopefully the progress continues. And this is a solid step in the right direction. Once one country approves the technology, it's going to be easier for other countries to approve the technology. And it's definitely could be a large market for something like robotaxis once the regulatory systems improve. Also, in final activity today in the options market from hedge funds and institutions, you had $227.52 million in options dollar amounts today, right? Bought and sold from hedge funds and institutions with a positive order value of 61%. That was actually lower than what you've seen recently. Now, again, for like 2 weeks in a row, every day short sellers have been covering on short positions, and today they covered on about 5,000 shares. So not a huge day for net covering, but still a net covering day nonetheless. And we've seen short interest fall a lot. Before we get into these shocking clips on CNBC, like, it's just ridiculous that that people even think this way. It's so political, it's crazy. But again, it's bullish as hell. Just shocking. Tomorrow, we're really not going to have much for economic data. You are going to have PPI month over month, core PPI, initial jobless claims. I don't really expect, unless we get some kind of shocking number here, that it's going to move markets all too much. Okay. You get Fed Barkin that will speak, and I believe another Fed official. Not exactly. I thought we had 2 Fed officials, but at least Fed Barkin will speak tomorrow. Friday's the big day with retail sales month over month, Michigan consumer sentiment, export prices, import prices, New York Empire State Manufacturing Index. All of this will be important. As I've said on the channel before, we're set up in a positive way heading into Friday because people have low expectations. They're not expecting any kind of strong numbers here. That leads me to be a little bit more positive, but then again, anything's possible. Okay, so first things first, I want to share this clip with you on CNBC from Tom Lee. It says CPI was better than expected, a rip off the Band-Aid moment. And then we're going to get into some of the clips about this market being a bubble. Crazy.
With the markets hitting new record highs once again after that CPI report that, in all honesty, it was kind of mixed. Headline was better than expected. Core was just slightly hotter than expected. What's your take on that?
Well, I think it's just a reflection of the fact that the market was bracing for a hot CPI, knowing that not only was the Fed, but economists were warning that we'd start to see inflation coming through in the July CPI report. So I think it was actually elevated compared to where it was in June, but I think it was much better than expected. So it's one of those rip off the Band-Aid moments.
All right. We were showing the CME Fed Watch tool earlier, just under a 95% chance of a cut coming up in September, being priced in by bond traders. That rate cut, what area of the market does it benefit? Does it definitely just benefit the cyclical sectors? What does it mean for the tech trade, et cetera?
To me, there's a whole area of the market that gets sort of lit up when the Fed gives sort of that all, dovish signal, or, Fed is resuming its cutting cycle. And I think that's things that benefit from liquidity. So that's financials, small caps, and also, believe it or not, Bitcoin.
Oh, Bitcoin. All right. That's interesting. By the way, potential rate cut. We've often thought we're going to get those rate cuts, and they don't actually happen, even though they're being heavily priced in right now. With that,
that's right.
I want to get to your word of the day. What's your word of the day today, Tom, and why?
The word of the day to me is breakaway. And the reason I'm saying that word is that in early July, Bitcoin made a breakaway move, and I think Bitcoin has been leading the markets by a month. So believe it or not, I think that this is the month that the S&P, makes new highs towards 6,500, 6,600.
Interesting. So you think we hit new highs this month? What's the catalyst? Because, we're pretty much through earnings season. So what pushes us higher other than a lot of optimism over a rate cut coming up?
Frank, I think part of it is positioning and sentiment, because I think investors were thinking this is the dog days of August and that we'd be getting some hawkish inflation data. So I think some of that's just the relief that, in fact, CPI was better than expected. I think it's also just follow through because we've had a pretty decent earnings season. And at the end of the day, the economy is holding up pretty well. And, I'd say that it has a lot to do with the fact that August will probably be a surprise and markets are going to be stronger.
All right. Tom, you didn't send us a pick, but I'm going to guess that Bitminer might be your pick today. It's a company that you're involved with. I want to talk to you about Ethereum and also Bitminer.
Yes. Well, Ethereum, has probably become the surprising sort of hit for cryptocurrencies this year because it's up 28%, outperforming Bitcoin. But in some of the work we've done, we believe it's the biggest macro trade over the next 10 to 15 years, and a lot of it has to do with the fact that stable coins have really become the chat GPT moment for crypto. And now we have the Genius Act and Project Crypto from the SEC, which is Wall Street essentially running onto the blockchain. But one of the best ways we believe to sort of have exposure is through Ethereum treasuries, and that's a company like Bitmine, which I've become chairman recently.
So when we're talking about Ethereum, it's one cryptocurrency. Stablecoins are obviously in the news, especially with the Circle IPO and Circle just reporting its earnings and offering more shares. And then you mentioned this Bitcoin as well. Why are you so bullish on Ethereum? What are the opportunities you're seeing in Ethereum in particular?
Well, Ethereum is the second largest blockchain, and it's different than Bitcoin because with Bitcoin, you can't really do programmable contracts, so smart contracts. Wall Street needs to find a stable and legally compliant blockchain to work on. The majority of stablecoin creations are taking place on Ethereum. And when you look at where JP Morgan is building a lot of its layer twos or Coinbase or Robinhood, they're choosing to do it on Ethereum. So it is the place where Wall Street is essentially financializing the system.
All right. So, by the way, you're not the only bullish person or bullish company when it comes to Ethereum. We're just looking right now. Standard Charter raising its year-end target for Ethereum to 7,500 from 4,000. Right now, Ethereum's trading right around, I believe, 4,700. Are you this bullish, 7,500 by year-end?
I think that's within the realm of expectations. Ethereum, I think first needs to clear its prior highs of around 4,800. It's within 6% of that now. Believe it or not, Bitcoin's obviously been making many new all-time highs this year, but Ethereum is still below its 2022 highs, 2021, 2022. So I think once it clears that level, I think Ethereum and small caps tend to be correlated. So to me, 7,500 actually might even be on the low end of what's possible.
Really?
I think I've seen many targets of 10 to 15,000.
All right, one more time before we get out of here. You're known for your granny shots. Can you give us one of your granny shots right now with the fact that we have the markets trading at all-time highs, the S&P and the NASDAQ, again, closing at record highs yesterday?
Yeah, I mean, I think really one of the granniest of our granny shots is NVIDIA. It's still one of the most important companies. Well, it's probably the most important company in the world. And in terms of forward multiple at 30 times, it's actually still reasonably priced. I believe its PE multiple is still ranks number 38. There are 37 stocks in the S&P 500 with a higher PE than NVIDIA.
Obviously, typically very bullish. Didn't really get a deviation from that in that clip. One thing that he said was very interesting is he believes the S&P could go to 6,500, 6,600 in August, which is definitely not in consensus. September, he's mentioned, could be a stronger month as well, which September is really the month where seasonals do not work in your favor. August has like an average return of negative 0.15%. It's kind of a 50-50 kind of month. It could either be really good, really bad, or not much happens. September has an average return of like negative 1%. So that is more so decisively a negative month historically. Now, this article says markets are more speculative and embracing more risk than in 2021. It says Wall Street Journal's Gunjan Baniri. Yeah. This is shocking.
Home trader is buying. Your next guest says that most investors are still bullish and they continue to pile money into some what might consider risky assets. Here now on set to name some names is Gunjan Banerjee, lead writer for Markets Live at the Wall Street Journal, also a CNBC contributor. Gunjan, good to have you on set.
Good to be here. Thanks, Brian.
We led the show. I don't know if you saw the top of the show with Chris Grisanti about how you can hate this market. You could say it's overvalued. You could say it's a bubble, but people are still buying. And that includes the retail investor.
They are still buying. They are still bullish. And, I think people think of 2021 as the peak of the speculative mania in markets, and they think things have calmed down since then. I think things are more speculative than they were even back then. And I think people are embracing more risk than they were even during the 2021 mania.
Okay, hold on now. That's a big statement because 2021, literally books are written about it. The Wall Street Bets crowd, Reddit investors We did whole segments on it. You think right now might be more speculative than then?
All you have to do is look at the amount of leverage out there, right? I'm sure you saw FINRA margin debt balances at all-time
Yeah, I look at it
highs.
all the time.
Well, and also individual investors, they tend to favor leveraged ETPs, assets under management for leveraged exchange-traded funds tied to equities. So these are bullish on equities. Those have topped around $119 billion. That's the highest level ever, going back to Morningstar direct records, going back to 1990.
Are these some of those products? And we're not picking on one product in particular, folks. But are you talking about the ones that are like 2x and 3x
Exactly.
bullish products? Like you buy something.
Tech,
yeah, but if they go
equities.
down, you're down 3 times, 2 times your money.
Sure. And take a look at what's happening in options, right? Individual investors loom larger in options than they did in 2021. Zero DTEs, prediction markets. You can now bet on where cryptocurrency prices will be within the next hour. So the market has become more gamified since 2021, and people have also embraced risk more than they have back then.
That what you said is so important because you can not only, and my producer and friend Max Meyer said this years ago on Last Call. It was good. I don't know if you saw that program.
I love joining you on Last Call.
It was the gamification of the stock market because the idea is it's not that you just even own a stock anymore. To your point, you can bet on where things are going without actually owning that thing.
Exactly. It's like instead of betting on the outcome of a sports game, you're betting on how many points LeBron James is going to make in the fourth quarter or something like that. So the time frame over which you can make bets on stocks and ETFs has gotten compressed, and people want to play the game.
Is there? I'm not picking on any company, but there's definitely a big game going on. I'm using my words carefully. In crypto right now.
Yes.
Today we have Bullish. That's the name of a company. It's an IPO. Started about 5 years ago. It's out of the Cayman Islands. That stock's soaring, right? We could probably show that. You've got Bitmine Immersion Technologies. Tom Lee's executive chairman. That stock, all it does is go up.
And
what do we make of all the stuff going on around crypto?
It's really interesting. To me, it feels like the new flavor of the SPAC, right? The SPAC was the hot thing a few years ago. Right now, it's these companies that are just buying loads of cryptocurrencies because people want to make these leveraged bets on crypto. I think a lot of the speculation is happening in Bitcoin, Ethereum, companies tied to that. It's happening in tech. When you look at some of the top names traded on Interactive Brokers, Fidelity, right? Those are the tech names. It's the NVIDIAs, AMD, Tesla. You're seeing animal spirits around stocks like Figma emerge as well.
Yeah, I wonder in those, by the way, Interactive Brokers, those names, they're down. One day doth not a trend make. They are down today. Some of the Mag 7 are actually down. I mean, it's actually.
Can you believe it? Does that happen?
It's allowed.
Does
Apparently,
that
it's legal. But I do wonder if some of that money is going to shift from the Apples or NVIDIAs, whatever, of the world to the bullishes of the world.
Yeah, you mean go into
say, you know what, I'm done with the AI trade. Let's go into Bitcoin. Let's go into crypto. I don't know. It feels that when you look at a Circle, when you look at a Bullish, when you look at a Bitmine Immersion Technologies, it seems kind of that way.
I think you are seeing a lot of people go into those crypto trades, but it does not seem like people are tired of the AI trade just yet. Not when you look at the top names traded on these brokerages, not when you look at the price action this year in some of these trades.
You probably get much nicer comments than I do. You must hear from readers and viewers. What are they saying? Because half of my feed is like, we're doomed. But they've been wrong. You can make a good case of why stocks should go down 20%, but they don't.
So I recently wrote about Generation Buy the Dip. This cohort of individual investors, a lot of them are younger, a lot of them haven't experienced 2008, the dot-com boom, when it took a lot longer for stocks to recover and reclaim new highs. The bounce backs the past few years have been a lot quicker.
As a little bit of a bonus, if you will, I want to share this clip with you. It says a September rate cut will extend the stock rally into year end, says Partners Group Anastasia Amorosa.
Is this really one of the best environments we've seen in some time for investing in both stocks and bonds? Anastasia Amoroso is Partners Group Chief Investment Strategist for Private Wealth and is here with us on set. Got a lot of play on this call that Rick Reeder made yesterday, sitting in this very chair. Do you agree with him?
I mean, I do. I think this environment has a lot of positives to it. And, coming into a couple of weeks ago, we were debating this quarter of adjustment and the fact that companies had to absorb the tariff increases. But now coming into this week, it's all about the rate cuts, and maybe not just one rate cut, but a series of rate cuts. And I think there's potentially a scope for 2 or 3 this year. So that does change the narrative quite a bit, because it really cushions whatever softness we were expecting to see in the third and fourth quarter.
Do you think there's better value in stocks or bonds right now?
I mean, look, I think we're not that far away from neutral rate. I don't think we're that far away from terminal rate. So maybe we get 75 basis points or 100 basis points of rate declines, and surely that props up the bond market. But I do, generally speaking, see more value in the equity markets, both public and private. I think you have a lot more innovation. I think you have a lot more room for earnings growth and potentially for earnings revisions. And Scott, moments like we had earlier today, and also just the IPO market in general this year, it's actually perking up. We are about 21% year over year in terms of IPO activity, about 30% in terms of M&A activity. So it does tell me that there's this value unlock that is likely to happen from this crossover from private to public markets.
Are there any feelings of euphoria that you would be concerned about when you see? This has nothing to do with the merits of a company like Bullish. They're obviously in the right place at the right time with a business that the market deems to be in a high growth area that's fast being deregulated. So I can see why this is up the way it is. Many of the other IPOs that have come public have done the same thing.
Yeah.
There are several, meme-like names within the public markets that have traded crazy in the last several months. Does any of that give you pause?
I mean, not on a broad scale. And I say that because if you look at the average IPO, that IPO this year over $1 billion, it's up about 50-60% depending on the day. And I think there's a lot of strength to those companies that have waited to go public for a long time. So there is the maturity stage of some of those companies. There's also the revenue and the earnings growth. So I wouldn't say broadly there's this degree of exuberance. I will say, Scott, that clearly there's a mispricing that's happening in the IPO market right now. And the fact that some of the companies are surging as much as they are suggests that demand is incredibly strong for some of these growth stories for both retail and institutional investors. And so I wouldn't necessarily say that's a sign of euphoria. Perhaps it is a sign of clarity. If you think about, why we're having this success with the IPO market is finally we have clarity around tariffs, whether we like the rate or not. Finally, we seem to be approaching clarity on what the Federal Reserve is going to do in the fall. And the U.S. economy, fine, it's slowing, but it's still growing at close to 2%. So that's a lot of certainty for those CEOs looking to take their companies public.
Are you a believer in the broadening story that some are now trying to tell again?
I am. I mean, look, financials, for example, is a sector that stands out to us, and that's really benefiting from all the trends that I discussed. The capital market activity is picking up a lot. If you look at consumer spending, the real-time data is showing 4 or 5% consumer spending growth in terms of credit card spending for the month of July. So, by the way, we get retail sales later this week, and I think that should be a fairly robust number. If you think about industrials and the big, beautiful bill that was passed and the incentive that is for industrial activity. So I do see many growth drivers. And then on top of all of that, Scott, there's, of course, the AI data center story. CoreWeave, fine, is not doing so well today, but we're big believers at Partners Group in the AI data center opportunity. If we look at some of our portfolio companies, like EdgeCore, for example, it is absolutely a platform for data center growth for hyperscalers. And AI data centers is exactly what they're building and scaling, because that's a much faster rate of growth than what you see generally in data centers.
All right, we'll leave it there. Thanks.
So let me know your thoughts on all of this down below in the comment section. Again, when it comes to Tesla, you've had this outperformance over the past couple of, the last week or so. The last 2 days, you haven't done much, but I think general risk on sentiment is going to be positive for Tesla. It just will be. I don't think you can have the Russell going up as much as it is and that not feed into Tesla also outperforming. Can there be days where the Russell does very well and Tesla doesn't do much? Yeah, I think that's kind of what's happened the last couple of days. But there will be a moment where Tesla will begin to outperform again. and it's coming in the not so distant future, in my view. Again, obviously, I'm bullish into the end of this year. I'm obviously more bullish than the average folks, so take that into your own calculations. I'm not a financial advisor. I'm not a financial planner. With that said, hit the like button as well as subscribe to the channel and check out the link down below in the description of this video if you want to come join the private trading community, the best one in the world, by the way. Have a great rest of your day, and I will see you in the next one.